exchange, because they're going to hold you to this high standard. And if it doesn't turn out their way, the way they anticipate it, they may look back to you. So the best thing you can do is recognize that it would benefit your client, give them some basic information about how it works, and then refer them to a qualified intermediary that specializes in this area. We have attorneys, we have lenders, CPAs need to, tax professionals need to always be involved, because they could have specific knowledge about this taxpayer that you nor I would have. For example, do they have loss carryovers from prior years that would help offset some of this capital gain tax that they have to pay? So it's very important that the taxpayer be proactive about involving his real estate person, his tax person, a qualified intermediary. And then escrow agents. Escrow agents have some responsibility in the exchange. Oh, you know what? I forgot to advance the slides. I'm sorry. So we're going to advance. Hello. Okay.
Is it going? There you go.
Yeah, we just went through all these. This is my first live webinar, so you'll have to cut me a little bit of slack. Okay. So this is what a qualified intermediary does. A lot of people, agents, and taxpayers don't understand that what the QI does is another piece of the closing transaction. We are just like the surveyor, the appraiser, the real estate agent. So the things that we do are we structure the exchange, we provide the documentation that's required by the IRS, we safeguard the funds of the taxpayer, we monitor the statutory time requirements that we're going to discuss later, and then we give a final accounting of all the funds that came in and out of the exchange. Things that we do not do. We do not provide replacement property options. A lot of people will call and say, hey, do you have any property that I can invest in? I can't do that ethically. And I don't need the response. I don't obviously want to take on the responsibility of offering an investment to someone that I have, no idea what's going on. We will advise on the types of investments that the taxpayer can do. They can sell commercial, and we will say, yeah, you can buy residential property, you can buy raw land, you can buy a Delaware statutory trust, you can buy a tenancy in common. But, and then we don't close the transaction, and we don't give tax advice nor do tax returns. What you can and can't exchange. On the side where you can see what can be exchanged, it's a wide variety of things. The most common use of Section 1031 Internal Revenue Code is real estate. These are real estate type investments. So, for example, you can, when you sell livestock on a ranch, you have to buy other livestock, but the ranch itself can be exchanged for any other real estate. And these are the types of things that you can exchange. The things that you absolutely cannot exchange is property that's being held primarily for sale. Your intent, the whole basis under a 1031 exchange is, what is the taxpayer's intent? Was his intent to buy that property and turn around and resell it? Was his intent to buy it, fix it up, and resell it? If that is the intent that the taxpayer goes into when they have a piece of investment property, and then they don't qualify for 1031 exchange. All the home builders out there, they don't qualify for 1031 exchanges. Flippers don't qualify for 1031 exchanges. You can't buy stocks, bonds, notes. You can't buy real estate investment trust. You cannot buy an interest in a partnership. If a partnership owns property and other things and you want a piece of that real estate, your client can't buy an interest in the partnership. He has to actually buy an interest in the real estate. So those are the kinds of things that cannot be exchanged. There's three basic requirements of the exchange. The first one I've already discussed. It has to be property for investment, business, or income. It can be the office building that you are in. It can be a piece of raw land that you think will be valuable someday. It can be a farm, a ranch, residential rentals, but it must be investment, business, or income and not personal use. It must be exchanged for property of like kind. One of the major changes to the tax code in 1986, the Tax Reform Act, was that any investment real estate is now like kind for any investment real estate. Prior to that, you could only exchange a residential rental for a residential rental. Now you can exchange any investment, business, or income property for any other, regardless of the use. The next one is it must be properly documented as an exchange. So where does that documentation start? There is no requirement by the IRS for you to put this document, to put anything in your contract regarding the exchange. You do it merely to anticipate or prevent any problems. For example, the person at the end, the other party, if your guy's the seller, the other party is going to be asked to sign a document at closing. If they have never heard of a 1031 exchange and you all of a sudden present it to them at closing, they might have an issue with that. They might say, I don't know what this is. I'm not going to sign it. Well, the real requirement is that they were notified. They don't have to sign anything. We just have them sign something so we have proof that they were notified. So it's up to you, and you have to look at your specific situation for your client to decide if a contract addendum needs to be added, which we have those. This is a generic contract addendum for replacement property. Anyone's welcome to have it. Stick it with your contract. This next thing is special provisions. You can put a note in special provisions that says something like this: seller to cooperate with buyer in a 1031 tax deferred exchange at no cost to seller. What their cooperation is we're going to ask them to sign the document. Other than that, they have no part or no role in your 1031 exchange. If you put these things, you know, the Trek commercial contract has a box you can check that says buyer or seller or both are doing a 1031 exchange. But if your investor is buying residential property, he's not going to find that. So you might want to stick something like this in your contract. Also, on the buy side, your rights to that contract are actually assigned to the qualified intermediary at the closing. The qualified intermediary never actually takes title, but the IRS requires this assignment, pie in the sky assignment. So if your guy's the buyer, you might want to always put John Smith and or assigns, because if someone's looking for a way to get out of that contract, they could say, oh, wait, you're assigning this to a qualified intermediary, even though the qualified intermediary isn't taking title. I didn't allow an assignment. You know, so those are things, that decisions that you make based on the nature and character or sensitivity of your contract. I mentioned that the track contract has this clause in it that you can just check if your party's doing an exchange. This is the tax form that your client must file. You're not responsible for making sure they do this, and I'm not responsible for making sure they do this, but many times they'll say, what happens? I mean, I got a 1099. Now I'm totally panicked. I shouldn't have gotten a 1099. This is a 1031 exchange. Well, this is the form the IRS matches with the 1099 to say, oh, this is why we're not getting a check from the taxpayer or the investor, is because they did a tax deferred exchange. If they start their exchange in 2017, they must report it on their 2017 tax return. They have to file an extension if necessary, or else their exchange will be denied. It doesn't delay your tax liability. If you sold in 2016, you're going to file that, and any kind of boot or tax that you had to pay, even though you did a 1031 exchange, is going to be paid with your 2016 tax return. So the advantage of the exchanging: to consolidate or diversify investments. Your client may have too many rentals and want to move into a commercial building. They may have all their eggs in one basket in a commercial building and decide they want to spread that out a little bit and get some smaller shopping centers or whatever. So they're moving for the type of units, residential, commercial, raw land, or they're moving, consolidating or diversifying. They may want to relocate. I'm sure I don't have to tell anyone in the room that we have a flock of people coming into Texas and coming into Austin, and these people are bringing their investments with them. I have a great deal of exchanges coming out of California, Florida, just everywhere, and they're flocking to the tune of 160 a day into Austin. And so usually when that person, I have a girl in California right now, she's just buying into Texas because it's hot and it's profitable. She's not physically relocating here, but she wants to relocate her investment. Leverage appreciation. You've got all this equity built up and you're thinking, okay, I'm going to take some of this equity and I'm going to leverage into a bigger, better building, newer building. Cash flow. Your client owns a bunch of farm and ranch land. He's no longer farming and ranching, but he's getting to the point where he wants to supplement his income. So you'll help him take this farm and ranch and transfer it into a commercial office project where he can, or residential rentals where he can collect rent and have cash flow. And then we'll discuss later, but it can be, as I mentioned in the beginning, it can be a real important part of estate planning. You can set up your exchange in a way that when you check out, your heirs do not have to pay whatever tax you have built up. Unless it's over like $6 million, they're going to walk away with all of the money and they're not going to write a check to the IRS. So just like any other taxes, you have to die to get out from under them, but it's like leaving your heirs that much more money. And I think everybody would rather give it to their children or their spouse than to Uncle Sam. So there are a few disadvantages to exchanging. It reduces the basis in your new property. So capital gains tax is the tax is determined by taking your basis in the property, your adjusted sales price of your new property, of that property, and that gap is taxed at anywhere from 15 to 23.8% currently. So say you deferred $100,000 in gain. When you go buy your new property, they immediately reduce the basis $100,000. So that old gain you're carrying around is kind of built into your properties as you move forward doing exchanges. And that's how the IRS, if you sell before you pass away, that's how the IRS knows how much you owe them, because they kept track of it built into the basis of the property. Says there's an increase in transactional cost. It's the exchange fee. That's the only transaction cost you're going to have because you did an exchange. And, every qualified intermediary around the country has their own little fee structure, including myself. And so you just have to check with the qualified intermediary and find out what that fee is. But it's a pretty small fee. I'll just tell you, my base fee is $850. So I do a lot of transactions in order to pay my bills. So, and then there's a limitation on the use of the equity. You've got all this equity you've built up. The only thing you can use it on now is new property if you do a 1031 exchange. If you touch that equity in any other way, shape, or form, you're going to pay taxes on it associated with how much ever cash you touch. So it does limit your use of your equity to only purchase new investment property. This is just something you can take a look at. It talks about, well, as I said, it reduces the basis. So if you bought a piece of property for $1.5 million and you deferred $259,500 in gain, your new basis in that property is now just the $240,500. And the reason that's important is because what I said, the tax is based on the difference in the basis and the sales price. So now when you go onto the new property, you bought it for $1.5 million, which is normally where your basis starts. But if you did an exchange, the basis starts down here. So what it does is it keeps that gap wider, that gap between what I bought it for and what I sell it for. It keeps that gap a little wider by the amount of the gain that you've deferred. So possible tax consequences, even though you did a 1031 exchange. People think, oh, if I do an exchange, I'm out from under this. It's not necessarily true. If you used your exchange dollars to pay for exchange expenses, then yes, you receive tax deferral on those dollars. If you use, and this is going to be really important if you're going through a settlement statement with your client or with yourself if you're doing an exchange. All hard closing costs, commissions, policy premiums, exchange fee, recording fees, those kinds of fees that would only have occurred because you sold this property, you can use exchange expense money and get tax deferral on that. But if you come up and start paying non-exchange, if I'm holding $500,000 for you and I send that whole $500,000 to your new property and you use it to pay your share of the prorated taxes, homeowners association, lenders fees, utilities, anything that is a normal annual operating expense, that's going to create tax liability. So having said that, most people keep that on their settlement statement because most escrow officers, most title companies want those tax prorations and things on there. You can handle those outside closing. You can have that other party bring you a cashier's check, or you can give that other party a cashier's check. Because if you're thinking of a commercial project that maybe the annual taxes are $50,000 and you go and pay those with exchange money, you've just generated a $50,000 cash boot, and that will be taxed at 15 to 23.8%. If you're buying a $200 residential property, investment property, and the taxes are $2,500, not such a big deal. But when you're dealing in a commercial environment, this could be very important. I just spent, well, I had an exchanger who just spent over $2,500 on HOA fees. And she wanted to pay for that out of her exchange. And I said, you pay for that, you've just generated $2,500 of taxable cash boot. So you have to be, and we look at these things and we advise people to do it in a way that they don't have any tax liability. But the reasons they don't sometimes is they don't want to mess with dealing with it, you know, with a separate check or cashier's check outside closing, or the contract says so, and the other party will not let you do anything outside the contract. So there's reasons that it stays on there, but you need to understand those non-exchange expenses are going to cause potential tax liability. And then this just happened yesterday. There was a lien against this property, technically a lien against the property they were selling, because someone had taken out a home equity loan and put almost $100,000 worth of improvements to their investment property 5 years ago. Well, now they're selling. Well, that was a home equity loan against their primary residence. So now they want to pay that off when they sell it. If they do that, they've just generated $100,000 of cash boot, because that loan was not technically tied to that piece of property. So it's just like they took $100,000 and paid a Visa and a MasterCard and whatever. The IRS doesn't care. That's considered, that was an unsecured debt. And when they took that cash, they created tax liability for themselves. And then seller financing. Seller financing does not work well with 1031 exchanges. If your client is selling a piece of property and intends to do seller financing, unless it's a large commercial property and they're going to get a huge chunk of money at the day of closing, it's not going to make sense, because you can only defer the capital gains on money that you receive the day of closing. So every subsequent year, when you get principal reductions, you have no choice. You can't 1031 that money. You have no choice but to pay taxes on the money when you get it in subsequent years. So very rarely do I see a situation where there's enough of a down payment, you know, large commercial project, where there's enough of a down payment to justify still doing an exchange if you're going to be doing seller financing. These are the current tax rates. We'll talk at closer to the end of the presentation about where we are with 1031s now, but the current tax rates are, so in 2013, the administration, IRS, Treasury, whoever was all involved, House Ways and Means, decided they were going to simplify the capital gains tax. So before, we all paid 15%. If you were considered a poverty level person, you paid 10%. That simple. It doesn't matter what your gains are, matters not. Everybody paid a flat 15. So they simplified it for us. Now you get to decide, first of all, am I paying a 15 or a 20% capital gain? As you can see, that depends on your adjusted gross income, 400 for a single person, 450 for married people or businesses. So 15 to 20%. Now you've decided, okay, you're 15 or you're 20. Now you get to also compute if you are subject to the 3.8% affordable healthcare tax on the sale of investments. That is so complicated that I've been reading through it since 2013, and I still have my doubts whether I could figure it out, this new simple process. But it has to do with your net investment income, including the sale of this property, in relation to your adjusted gross income. So you go through that calculation, and so if you are subject to the 3.8, then you will pay the 15 plus 3.8 or the 20 plus 3.8. So you can pay 15, 18.8, 20, 23.8. Now if you're in the poverty level, you pay 0. So that's our simplification. That's how simple it is now. Hello. And then and also in 2013, the ordinary income tax rate was increased to a high of 39.6. So if your investment is a short-term capital gain, meaning you've owned it less than a year, you could be paying 39.6% tax. Will they have access to this? Okay, so I don't want to go through this line by line because I'm trying to save some time for some really complicated stuff at the end. I'm assuming we're okay so far. But this just tells you, will give you, if you're trying to help your client just in general kind of work through, hey, does an exchange make sense for me? I will also help them with that. But this just gives you an idea of the very simple, most basic. And this is nothing they can, their situation is going to have little bitty nicks and tucks, but this is the basic format to determine this person sold, a piece of property, for $975,000. If they had not done an exchange, their tax was still $84,911, but had they done an exchange, they could have deferred that and kept that 84 to help leverage into more or bigger, better property. If this person did, this is investment benefits if you don't do an exchange. So adjusted sales price is $450. The basis was $200. So now their taxable gain is the difference in their adjusted sales price, adjusted by the cost of sale, and their adjusted basis, which is their purchase price plus capital improvements minus depreciation. None of that you really need to know. That's their tax person's responsibility. But they get to their taxable gain by figuring that out. And then they have to pay you have to pay back 25% of any depreciation you've taken. So you may not have any gain in a property. You may have bought it for $500 and sold it for $500, but you held it for 10 years. And over those 10 years, you were taking depreciation. You've got taxable gain because you have to recapture 25% of the depreciation that was taken. So the tax on the disposition of this property without doing exchange was their $250 taxable gain times, I just assumed the 20%, because I know we all make more than $450,000 a year. And then I took 25% of the recaptured depreciation. So without an exchange, this person had paid taxes of $61,250, leaving them $388,750 to reinvest. Now they did an exchange, kind of the same thing. All they do is they get down to their net proceeds and they get the full $450, not the $388, and that remaining money that they have allows them to leverage into an additional $306,000 worth of property. That's why people do exchanges sometimes, because they don't necessarily want to sell the property. It's nice, but they want to leverage into something else. So they want to take that. They don't want that equity just sitting there not working for them. What does it do on depreciation? We talked about that. It reduces when you've been depreciating an asset for 27 and a half years. Commercial building, I think, is a little more. You now have lost some of the depreciation. You don't get to start over again for 27 and a half years with your new property, because you've already been taking depreciation and you did a tax deferred exchange. So the depreciation you've taken is moved into the new property. We don't need to go into the details of this. This is important for the CPA. The only reason I mention it to you guys, because it's way over all of our pay grades, is because I want people to understand that the impacts of an exchange is that it reduces their basis. It has an impact on depreciation. So I don't want taxpayers out there thinking, oh, I walked away from having to pay this tax and nothing is ever going to happen. It's just simple. I'm just going to go buy something new. Because if they had a commercial office building and they had furniture and fixtures in there that they were depreciating, they sell it, their CPA is still going to calculate gain and tax on the furniture and fixtures, even though they did a 1031 exchange. So depending on the type of property that they have, it may not be enough to defer all the gain just to sell the building and move on. They've got what's called Section 1245 property in there that is still going to could still potentially generate some taxable gain at the ordinary income rate. So just things to be aware of. We talked about that. Now, these are some rules that trip people up. Step transaction rule. The IRS says if a series of events happen in a short period of time, we're going to collapse it and act like they all happened on one day. So there's these taxpayers that think, I can game the system. I know how to do this. I'm just going to go take out a big fat mortgage on my property right before it sells. I'm going to put that $100,000 in my pocket and I'm going to take that out, week before closing. And then that way I'll just go and buy a new piece of property and I've got $100,000 I didn't have to pay tax on. If the IRS finds out about that, they're going to say, oh, we're going to collapse that and act like you took that $100,000 the day of closing, which you're able to do, but you have to pay taxes on. So you want to be really careful about placing a mortgage before and after immediately before and after an exchange. After an exchange, if you're taking out a loan against the property and it's for a true legit business purpose, like I'm going to buy inventory or I'm going to start developing or doing improvements, that's okay. It's just you don't want to take this money and put it in your pocket. That's trying to game the system, and it's not accepted very well. Same thing if you want to change title immediately before and after the exchange. So if you own this property in a partnership name and you individually want to do an exchange, and so you immediately deed the asset down to the partners, and then you go depends. Did you own it less than a year because you bought it, fixed it up, and intended to resell it? Nope, can't do an exchange. But did you buy it, have it for a little while, and a couple things may have happened. You may have gotten an offer you can't refuse on it because this market is so crazy. Or two, you may have found a bigger, better project. You may have just bought that one just to keep your exchange alive because your time periods are running out, but now the property that you really wanted is available, so you're selling and going on. So you can do an exchange on property held less than a year. You just have to have a good, legit, valid reason and not, I always intended to resell it. So that's just a misconception. And that's what we were talking about, your intent. When you got that property, were you intending to turn around and resell it? IRS is really big. If they ever audit someone and they're looking at their exchange, that word intent is going to come up over and over and over. You have to have held it for a qualified purpose. And what are the qualified purposes? Investment, income, or business. Dealer property, they won't give you a hard definition about what dealer property is, but dealer property is if your intent was wrong, and the IRS won't hard code the definition because they want to be able to look at the whole situation and see if you're a dealer. If you're a D.R. Horton, you're a dealer. If you're a guy who's done this once in his life, you're probably not a dealer. If you're someone who's done it 4 or 5 times in your life or 4 or 5 times the last few years, you may or may not. The IRS is going to decide when they audit you if you're a dealer. And just so you know, by doing the 1031 exchange, there's no evidence that you increase the chances of an audit. It's just that, just like anything else, when the IRS audits you, they're going to look carefully at it, just like they will at anything. And probably because they probably won't even know what an exchange is until they audit you. So they'll look at it carefully. 1 and 2 year tolling periods. If you want to prove your intent to the IRS, it is best that you hold on to the property. The IRS says, we're comfortable if you've held on to it for a year before you resell it and go on and do another exchange or whatever. We're comfortable that your intent was true. If you want to occupy that property as your personal residence, the IRS says, well, we're comfortable after 2 years. So after 2 years of owning this property and treating it as an investment property, not just letting the lake house sit, but treating it as an investment property, you want to move into it and occupy it or change that lake house to your sole use, you can do that and it doesn't trigger the tax. The tax is never triggered until the property changes hands, the deed is changed. Section 121 of the Internal Revenue Code, primary residence exemption. This is what people get for their primary residence. This is why they don't get 1031 exchange, because this is what the IRS gives them. They can have these complete exemptions. You check a box on your form and you said, nope, I did not earn more than $500,000 on the gain on the sale of my primary residence, and you can take whatever you earned and throw it in the ditch. The IRS doesn't care. No taxes. People call me all the time and say, well, I'm selling my house and I've earned this. You don't need me. You can't use me. This isn't what it's intended. It's for investors. If this person gains more than 250 or 500, cannot do a 1031 exchange. They have to pay the tax because this is for investment property only. So good problem if you gained more than 500,000 on the sale of your primary residence, but bad problem, you're going to pay tax on the extra. And then condemnation and voluntary conversion. You don't need, don't use, and aren't required to have a qualified intermediary. You could touch the money, which you can't do with an exchange. You can take 2 or 3 years, depending on what you intend to do with the money to do it. You have to let the IRS know what you're doing. And unlike a 1031 exchange, you can do something on land you already own. So, but you want to make sure that you can't just say, oh, I think someone was going to condemn me, so I'm going to do a 1033. You have to have something that proves that it was a real explicit true threat, a letter from the county or the state or whatever. And then you just go on and you take your own time, sweet time, and you can touch your money and do what you want with it for the next 2 or 3 years. This one we won't spend much time on, but these are other types of exchanges. You can exchange dump trucks for dump trucks. I've done construction cranes for construction cranes, horses for thoroughbreds, you know, all kinds of perpetual classic cars, perpetual water rights. All these things can be exchanged, but if you're outside real estate, the dump truck has to be a dump truck. The classic car has to be a classic car. The thoroughbred racehorse has to be a thoroughbred. So, but for real estate, as we mentioned, it's really, really broad. Some things, if your person is selling a business, they'll pay taxes on the value of the goodwill. And this is important because sometimes real estate professionals will assign values to these things in the contract. So you'll say, okay, we think goodwill is worth this, and we think the inventory is worth this, and the covenant to not compete is worth this. And when you do that, that's a taxable asset. It's not exchangeable, the value of that. So you have to think very carefully when you're putting that kind of stuff in there, what it is. Identification rules, 45 days from the date of closing to identify potential replacement property. 180 days from the date of closing to actually close on your new replacement property. Once the 45 is passed, no substitutions for any reason other than a government-declared natural disaster. These are the only things in this section of the tax code that are set by law. So there's no way around them. It doesn't matter. You could tell the biggest sob story, and it could even be true, and it's not going to change anything. No limit to the number of properties that can be sold or purchased in an exchange. The extensions are allowed, like I said, only when there's a government-declared natural disaster. And who receives the designation? You don't have to give it to me. They can give it to you. But then you, as the real estate person, are now responsible for proving to the IRS that it was made timely. That's why we have them give it to us, so that I can be responsible for that. They have 3 options as far as designation. They can limit 3 properties, list 1 to 3 properties of any value. They can list more than 3 properties as long as the aggregate value is not more than 2 times what they sold. So if they sold something for $1 million, they can list $2 million worth of property. And then the 95% rule that I've not seen used in 26 years, which is you can list as many properties as you want, but you have to buy 95% of the total value. And that's a really hard thing to manage, so it never gets used. The description is 123 Main Street, Austin, Texas. Or if it's a construction or improvement exchange, it's 123 Main Street, Austin, Texas, to include a 2,000 square foot metal building, you know, with loading dock, you know, something like that. That's how it is. If you have multiple sales, the only thing to be concerned about when you have more properties in the exchange than one is that tolling period, that 180 days and that 45 days, they start when the first one sells. You can split into separate exchanges. You have separate exchange fees, and you can still all go buy one property. But if you put all these sales into one exchange, you need to know by day 45 your list of what you're going to spend with all the money. The others don't have to sell by day 45, but you won't have a separate identification for them. And then you have to receive substantially what you designated. If you say, I'm going to buy 50% of 123 Main Street, and instead you buy 95% of 123 Main Street, that's not what you designated, and you have a bad designation. Substantially, if I say I'm going to buy 50% of 123 Main Street and I buy 65, yeah, I bought substantially what I designated. So that's what the IRS will be looking at. Constructive receipt, any money you touch, the end of the exchange, during the exchange, at the day of closing of the sale is taxable, and it's called boot, cash boot. And you will pay taxes on it regardless of what else you do in the exchange. So you can actually have a part sale and a part exchange where you say, okay, I'm going to take some money and pay taxes on it, and I'm going to exchange the rest, and I'll help you figure out if you're taking too much so it won't make sense for you. You can also say, hey, I have a rental unit out behind my house and I'm selling. Can I exchange that rental unit? Yes, you can. The value of the rental unit can be exchanged. The value of your primary residence you can take and throw in the ditch. So you can have a partial exchange. If you're going to take cash from closing, has to be stated in the exchange documents. There's a court case where the exchange failed because it was not. It has to come directly from the title company. Once I have the money, I can't give it back to you. If you are getting earnest money and option fees, you should put those into the exchange, or they become taxable. They won't blow your exchange, but they will become taxable. I'm going to go over really quickly. The main point is I want you to know that I am limited by the IRS to when I can return funds to the taxpayer, and this really makes my clients angry. So if you've bought everything by day 46, or you haven't identified anything by day 46, I can give you back your money. If you've got properties on there, regardless of whether you ever can buy them, I can't give you your money back till the end of the 180-day exchange period. So there are limitations, and this is in my documents in at least 3 places, and it comes up every day, and people still are confused by it. So you always need to talk really careful to the client to find out what it is that they're intending, what their intentions and thoughts are in the process. I try to do that, but somehow it just doesn't go. We talked about taxable boot. That's cash if you receive it. That's also if you trade down in value. To get a full tax deferral, if you have an adjusted sales price of $450, you have to spend $450. If you spend $350, you've just got $100,000 of boot, and that may or may not end up making your exchange worthwhile. We talked about the drop-in swaps, co-tenancy versus partnerships. If the taxpayer is a partnership, the same taxpayer rule says that the partnership needs to do the exchange. Some people say, no, we're just co-tenants. But if your CPA has been filing a 1065 and reporting that like a partnership return, you're a partnership in the eyes of the IRS. And that means the partnership has to do the exchange. DSTs and TICs, Delaware Statutory Trust and Tenancies in Common. Your clients can invest in these. They're often used as a bailout because you can get into them that fast. You can call up and say, I've got $50,000. You got a CVS somewhere I can invest in? And you get in touch with these people who sponsor these things, and you buy yourself an undivided interest in whatever it is, medical building in Houston, eye surgery center in Chicago. But these are bailouts. If your client's not going to be able to spend all their money, but they don't want to pay any taxes, they can take that last bit and throw it into something like this. Let's see. You cannot buy from a related party unless the related party also does an exchange. Related party is lineal descendants, grandparents, kids down, and siblings, and a company that you own a greater than 50% interest in. Just because you get very little proceeds out of a deal doesn't mean you don't have a huge tax consequence. I had a client in Waco who had been cash out refining. Every time he got equity, he'd cash it out and put it in his pocket, not pay the IRS any money. Came to the day he was selling, he got $585 out of the closing, and he had over $200,000 in tax liability. So he had to take his $585 and go do an exchange. So don't let proceeds lead you to believe that the tax situation isn't necessary for an exchange. You cannot build on land you already own. You can only do exchanges on vacation and second homes if you have been limiting your use for the 2 years prior to the sale to the greater of 14 days or 10% of the time it was rented in each of the 2 years. So you can do an exchange on vacation and second homes, but you have to plan for it. Now we got 15 minutes to get into the really hard stuff. So other types of exchanges that you can do. Ones we've been talking about today is a deferred exchange. I sell something and I buy something. Really popular, I did 30 of them in probably the last 6, 7, 8 months, is the reverse exchange. I had a big conversation about one on the way here this morning. You can buy the property, your target property, before you sell your other property. You still have to get the other property sold in 180 days, but it's very complicated and it's pretty expensive. we have to take the title to the new property or the old property and park it in the name of an LLC. We do leases. I mean, there's all kinds of documentation that allows the taxpayer the use of the property, but what you need to know is that the lender, if there's a lender, the lender has to get involved, and that complicates it. So if somebody says, hey, can I buy that before I sell this? Because I just want to lock it in. Yeah, they can, but you better get on the phone to the QI right then. You better put them in touch with the lender and start working. And I probably have one of the lowest fees in the country for it, and my fee's $5,000. And that's, you know, so like I told you a while ago, a base exchange fee is $850. You can see that, I mean, in Idaho, it costs $10,000 to do a reverse exchange. You can also do a build to suit or construction. You can take your money and we'll use it to buy a piece of property and we'll construct something on it. But you have 180 days to get that construction done. And so it's going to have to be something that's not too complex, and definitely not in the city of Austin, because it's not going to happen. So, but just so you know, you can do it. You can also do reverse construction exchanges, which make everybody at my office smile. Very complicated. They're not as expensive as a reverse exchange, but they're quite complicated. This just says that we're going to park it in the name of an LLC. It's called an exchange accommodation title holder. You still have to follow the 45 days and the 180 days. And if you're doing construction, we have to be very careful in identifying the construction. If you fail your reverse or improvement exchange, then you just end up with, if it's a reverse, you just end up with both properties. We pull out past title from the LLC to the taxpayer. Taxpayer just has two properties. If it's got improvements on it, you're stuck with whatever the value of those improvements are. But the qualified intermediary on day 180 is out of the project. You can do a combination reverse and deferred. You can start out with a reverse exchange, and then when you sell, you have more money than you need to close out the reverse, so you can start a whole new forward exchange if you want. Exchanges outside the safe harbor, I don't do. The IRS says, here's a roadmap, and if you follow this roadmap, we will not deny your exchange. That roadmap is called the safe harbor. If you veer off any highway on that roadmap, if you take 181 days or you change the taxpayer, you have now violated the safe harbor, and the IRS can deny your exchange for any old reason they want to. The reason this works well with an estate planning is that it's an estate planning rule that says you get this stepped up basis, meaning the property, you don't have that old basis they have that may have taxable gain built into it. The day you inherit it, you get the value of the property that day. So if you go out and sell it that day, there is no gap between the basis and the sales price, so there's nothing for the IRS to tax. If you hold on to it for a year and it goes up just a little bit, then now what you're taxed on is just that little bit that it increased. You never have to go back. So this is important for people to know when they deed something to their kids. They think, oh, I'm not going to live much longer, I'm just going to deed all my property to the kids. What you've done is you've deeded them your basis, because if you're alive when you give that property away to someone, you have deeded them your basis and the property, whereas when you pass away, they get the stepped up basis. So you have to think about that when your clients are talking about, oh, I'm going to get my mom's property. You can also, we talked about doing a combination of how I said you've got the house that sits with the rental unit in the back. You can do a section 121 primary residence exemption on the front part and a 1031 on the back part. After you move into a house that you've held for 2 years as investment, and when you sell it after 5 years, you also have part taxable gain and part 121. And this just shows, I'll let y'all look through, this just shows how you benefit, that you don't have to recognize that old gain. It's a very simple, okay. So what is on the horizon for 1031s? This is the big question that everyone is asking. If you had asked me this in January of this year, I would have told you that I'm playing with my horse in the pasture every day now, because I no longer have a job. Because Section 21 was going to be, Section 1031 was going to be done away with. It was supposed to have happened by March. They were going to replace it with what they call immediate expensing. So when you buy an asset, you go out and you buy a commercial building for $3 million, you have an immediate $3 million write-off on your tax return. And then, so you have this loss and you can only take so much loss per year. So you're forced to take this loss because I think that if you buy a $3 million tax return, you're not going to, I mean, a property, you're not going to have that much money to offset that big, huge expense. But assuming that you don't have, you know, enough expenses to offset that, your loss is going to carry forward. And at some point in time, you know, at some point in time, you'll eventually have exhausted that loss. What this immediate expensing, which is in the blueprint for tax reform, does is it doesn't address the value of land. And as you can see, approximately 30% of the value of commercial improved properties is in the land. And of course, 100% of agricultural investments are in the land. So they're only allowing you to immediately write off the expenses. The cost of that office building sitting there on that property, you're going to immediately write it off. But the value of that land, so think about a piece of property in East Austin. You know, there could be a little bitty junky 400 square foot shack on there, but that property may be worth $1 million. So the guy who buys it gets to write off the little junky shack, but he's paying taxes. He's going to end up paying taxes eventually on the $1 million for the land. So it completely ignores land value. The other thing so it doesn't say that it eliminates Section 1031 or repeals Section 1031, but the process itself makes no need for a 1031 unless we can get them to include, to allow people to do a 1031 on the value of the land. Then there's also a big move to just completely eliminate Section 1031 because the IRS wants your money. They don't like 1031s. They just soon you get on down the road with your business and not, you know, write them the check. What they don't realize is that 6% of all commercial real estate in the United States involves a 1031 exchange. 40% of realtors say that a transaction that they were involved in would not have happened had it not been an exchange. And 60% of all realtors have actually participated in an exchange. So what's going to happen when you can no longer exchange? That activity is going to come to a screeching halt because people are like, I'm not going to pay 20 some odd %. You know, the values are going to escalate because people are going to try to recapture some of that gain. Rents are going to go up. Sales are going to go down. I mean, people like real estate closing officers, appraisers, loan officers, escrow, all those people are going to be out of jobs because our economy is going to stop. And we as an industry, the Federation of Exchange Accommodators, have spent hundreds of thousands of dollars on independent studies trying to prove this to the tax writing committees in DC and saying, well, you're not gaining anything. You may gain everybody's taxes, but you're going to lose so much more in the movement of economy. And then so after March passed and we all took a big breath, then we were told, okay, August, this is coming out in August. We're going to get it done in August. And then because there's been so many other problems and things going on in Washington, it's all sort of been dropped. And now we're hearing by the end of the year, we could either have a repeal of 1031, we could have a higher tax rate because repeal is not a good idea, or some version of this blueprint could go in and devastate the economy because it doesn't include the value of the land. It only addresses improvements. So there's a website called 1031taxreform.com. I don't think it's a .org. If you want to contact, you know, people, I think I wrote it down somewhere. Anyway, if you want to contact someone and express your desire, 1031taxreform.org. It is a .org. You can go on that website and find out who to contact in your area. But 1031s have never been on the chopping block. In the last 5 years, they've been in the top 5. In the last couple years, they've been in the top 3. And now they're 1 or 2 as far as something that's going to be targeted for tax reform for elimination. So it's very important for all of us. And that's it. And I'm sorry that was so fast and furious, but there's just so much about 1031 exchange. We have time for a few questions.
Does anybody from our video class, our questions? Sign out. From the chat and the question boxes. Someone asked if commissions reduce the basis. So I think that must have meant the broker or agent's
Right.
commission.
No, sales commissions are an allowed exchange expense. So no, they don't reduce the basis. What they effectively do is reduce the adjusted sales price, which lowers that gap. So it actually, commissions are an allowed exchange expense, and they will not impact the basis. They positively impact tax liability.
Great. So, and then somebody else had asked if we are able to receive commissions as a buyer agent if we're also owner using a 1031. But so I think that,
Yeah. Yes,
answered that
you
question,
can.
right?
You can be paid commissions. The one thing you want to be mindful of, everybody needs income and we pay taxes on it, but the one thing you want to be mindful of is that your commissions are taxed at your ordinary income tax rate. Capital gains are much lower. So if you don't want or need that income, don't charge a commission and leave that money into the funds that are going to receive tax deferral. But you're absolutely able to take commission.
Okay. And the reverse exchange sounded so incredibly complicated. What is the benefit of the reverse exchange if it's that much trouble?
The benefit is that if you have a low basis, therefore a high tax property that you haven't sold yet, and you don't want to pay taxes on it, you go ahead and buy a piece of property knowing that when you sell that one, you can take the proceeds, pay off this property, and defer the gain. So it's just, if a person just can't get their property sold and they need or want or have to buy another piece of property, they'll enter into the reverse just because that's their only option. The only other option is to buy that property, and then when they sell, either go buy another property or just lose the tax dollars.
But they still have to do it within that.
They have to do it within the
window.
Yeah, the 180 window, and they're very, very popular, especially in a market that moves so fast like this. People have a property they want to nail down, so they're willing to go ahead and buy it and then take however long up to the 180 days to get the other one sold.
It seems like it would only be a good thing to do if you had a really good idea of what you were going to be.
That, and that you want to have enough tax liability in what you're selling to justify a $5,000 fee.
I have some questions about, if you 1031 wait 2 years, then occupy, can you take $500K tax-free as a married couple?
You can. Yes, you can take up to that, because what actually happens is the CPA will say, okay, you sold this property, you owned it for 5 years. The first 2 years it was investment, and then you lived in it for 3. Now you're selling it. We're selling it for $500,000. We're going to take $300,000 and go over here and do a 121 calculation, and we're going to take $200,000 and go over here and do a capital gains calculation. So you can take it. You may not get the full 500, but you can take it up to that. Somebody in that room in Central Hill Country had a question.
Okie dokie. I'm unmuting Central Hill Country.
Yes. How many weeks in a calendar year with your 1031 exchange rental property do you have to have it leased out? And I ask this because when we purchased a property that had to have more remodel than we thought it was going to have. Okay,
so the answer to that is, it's not so much renting only impacts how long you rent it only impacts the number of days you're allowed to use it for pleasure and enjoyment. So you buy it, you rent it for 150 days, you've got 15 days of pure pleasure and enjoyment for that property. Anytime that you spend there doing repairs and maintenance, attending homeowners associations, painting the fence, refreshing the linens, none of that counts towards your personal use time. So if you rent it for 300 days, you get 30 days of personal use, but that's just personal pleasure. That other stuff you're talking about doesn't count. You can do that for as many days as you want.
Okay, but is there a minimum that we have to rent it out per year to make sure we're in compliance and proving that it is investment free?
Yeah, no, there is no minimum. What they will look at if you ever get audited, they will want to see something that show that you made it available for rent at a reasonable, there's no minimum that you have to rent it.
Okay, I was concerned because it's already almost July.
Yeah, no. You just want to make sure that you are showing that you treated it as investment, you were working on it, it was available to be rented through it, at some point during the year, that there is no minimum. I mean, your personal use can even be 14 days if you haven't rented it a day. You just don't want it to be so blatant that it looks like, oh, it's just sitting here till I can pass my 2-year mark.
No.
You just don't want to do that. But no, you're fine if you just get to do what you're doing.
I have my own house. These are bed and breakfasts.
Right.
Okay, I do have a couple more questions. I know we're running a little long, folks, so if you do have to split, we won't take it personally. And a couple of things before we do scram, in case you have to, we do have another webinar coming up next month, which will be on July 18, and this one's going to be on commercial real estate tech. It's going to feature Michael Beckerman, who runs a service called the News Funnel and the Real Estate Tech News, talking about interesting new tech developments for commercial brokers and agents. But if you've got another minute or two, we can throw a couple more questions out there. Someone's asking, can a left-hand single-member LLC exchange to a right-hand separate single-member LLC owned by an individual? So can your LLCs function, I guess, as...
Usually that comes up like in a series LLC question. The answer is, as long as they are disregarded. So you can have separate LLCs that have a common taxpayer. And so I think what you're asking, the answer is yes, but how you know for certain is if you check with your CPA and you say, are these disregarded entities, and as a taxpayer, are they the same taxpayer? Right. And the CPA can answer that. You know, not knowing how they're set up, I can't. But as long as they are considered the same taxpayer for tax purposes, you can do that.
Great.
And I was going to tell everyone real quick, my email is tperson@1031exchangecorp.com. And it's free to call and ask questions anytime you want. Give me scenarios, I'll go over them with you, but you can contact me and we're happy to answer any questions.
And I will make these slides available. We will upload them to the TAR website, and I'll shoot out an email to all the attendees. So if you're registered, I'll get you an email. If you didn't register and you want the slideshow link, you can email me, and I am agamber@texasrealtors.com, or you can just call the TAR offices and ask for me, and they'll transfer you. Just get hold of Amy at TAR, and we'll work it out. So I have one more question, and then we're going to wrap up. Do you expect a little lead time notification period and/or exemption period by the IRS for eliminating 1031, or would it likely take effect immediately if it does take effect?
What we've heard so far, and I'm pretty intimately involved in this. I'm the incoming president for the National Association, so I've been on these fly-ins to DC, and so we've heard a lot from a lot of important people. And what we have been told, that any change like this will take effect January of 2018. So if they do manage to push through some kind of tax reform, they don't intend, but then they'll stop it cold right then. If your exchange has already started, then you're good. But we've been told it'll be January 1st of 2018, if and when it happens.
Okay. All right, great. I think we better let everybody go.
Yep.
So thanks very, very much, everybody. Like I said, if you still have questions about where to get the slideshow, go ahead and contact me, agamber@texasrealtors.com, or call the office here and ask them to put you through to me, and we'll get you set up. Teresa, thank you so much.
Thank you.
This was really super informative. You have to come over here and turn everybody off.
All right.
Okay.
Take care, everybody. Have a great day. Stop.
Well, that's unusual because we usually have 4,000 questions, but maybe in this format.
Yeah, it's a little less.
Less personal. Well, that was a whole lot of information for those people to
It is.
absorb,
It's
and I
a
don't
lot.
think, I don't know.